Welcome to DS Lombard. Today we're going to give you an overview of our monthly strategy as we head into the new year and a new president in the US. The topic, what emerging market investors should be worried about with Trump. But first, let's highlight our overarching themes. Number one, we remain bullish on emerging market equities. We think global growth has continued to accelerate in recent months, and we think the outlook, certainly for the next 3 to 6 months, will be very favorable for equities. And in particular, we think emerging market equities, which initially lagged the Trump rally, I think are well positioned to catch up, and perhaps US equities probably are likely to go into a correction. Secondly, with regard to emerging market credit, we think that the environment is still very positive for emerging market credit, notwithstanding the sell-off that we've seen in the bond market. Our figures highlight that emerging market spreads continue to tighten, and we think that as a trading theme will be dominant in the next 6 months. So we retain our positive call on emerging market credit. What is there to worry about with Trump? Well, the key issue that we're worried about is this slide into protectionism. Trump has said a lot of things, in particular during the campaign, but even more recently, yesterday, for example, in a press conference, he highlighted that he wanted to punish firms that export jobs. And he's backed up his rhetoric with actions. He's appointed 2 what we would call trade warriors to his economic team. We would note that other members of his economic team are pro-trade. So I think it's very difficult at this moment to figure out how trade policy is likely to evolve. Now, the notion that we can identify the origin of, for example, US imports and associate that with a particular country is a notion that we think is probably several decades out of date. Just to give you an example, the Mexican government has done research that highlights that 40% of Mexican exports to the US, which are in large major manufactured products, incorporate components that originally came for the US. So if you punish those imports, you're also going to punish those US workers who were manufacturing those components. And if we look at China, we can see the same thing. We take the example of the iPhone, which is assembled in China, but a lot of the components come from other countries in the region. So the notion that Trump is going to be able to protect US jobs, for example, by levying a border tax, is something that simply cannot happen. Our conclusion is that the trade policy that's likely to come out of the Trump administration is to be very tough in administering the trade protection features of existing agreements, but we don't think that an across-the-board tariff such as been talked about is at all feasible and would be found to be in accordance with WTO regulations. The other issue we would highlight is the prospect for retaliation. If we look at China, for example, our research tells us that China is in a position to hurt the US more than US is in a position to hurt Chinese economic interests. And that's simply because US FDI in China is vulnerable, whereas China FDI in the US has the protection of law. If we look at Mexico, the situation is not quite so favorable for Mexico. And that's the simple reason that we have some millions of Mexicans, both legal and illegal, in the United States, and in a very real sense, they are hostage to how U.S.-Mexican negotiations come out. So we expect that Mexico will seek to create a lobbying effort with U.S. firms that are invested in Mexico. But this issue is not going to be resolved soon, and we think that it is likely to hang over and be a cloud on the outlook for the next 3 to 6 months. That's it for this week. We'll talk to you again next month.